Hello there, welcome to the News Hour. Now, just in the last minute, the US Federal Reserve has announced its interest rate decision. It's putting the federal interest rate up by 0.25 points. That means the overall rate now sits at 5%. Let's go straight to our correspondent, Jazeera Castro. She's outside the Federal Reserve in Washington, D.C. This was the decision, Heidi, that the Federal Reserve was widely expected to take, wasn't it?
That's right. These are expectations that came after the turmoil we saw catch fire in the banking sector in the U.S. in just the last 2 weeks. Originally, it had been predicted that today's rate hike would be closer to half a percentage point. So seeing a quarter percentage point is what the expectations had tampered down to be in light of the recent developments. Of course, this is all due to the two bank failures that we saw starting on March 10th with Silicon Valley Bank in California when it was taken over by the federal regulators after failing. Why did it fail? It could not keep up with the withdrawals from its depositors because its assets had so sharply declined in value, in part due to the continuous raising of interest rates that we've seen out of this central bank in the last year. Of course, the purpose of these interest rate hikes is to combat this inflation that remains high, though we have seen movement downwards in the last few months. So the Fed board taking this action now, raising the federal interest rate by a quarter percentage point, certainly a response to what we've seen in the banking sector these last 2 weeks.
Yeah, it really is a very delicate balancing situation that the Fed finds itself in. What's going to be the reaction, do we think, to this? Is it going to be the reaction that it's looking for?
That's right. We're certainly going to be watching how the markets react. They have been trading very cautiously prior to this decision, but there have been some expectation that there would be no movement on the interest rate at all. So, in a sense, the Federal Reserve Board threading the needle there, not going right in the middle of what had been expected prior to the bank failures and the absolute no movement that had also been predicted by some. But really, what we're going to look forward to, as Jerome Powell, the federal chair, gives his news conference in about half an hour's time, are some pointed questions as to if more could have been done to prevent the bank failures, not only Silicon Valley Bank, but also Signature Bank in the days after. Because the Federal Reserve had been supervising Silicon Valley Bank in the year leading up to this failure, and there have been multiple red flags. There have been warnings given to the bank managers about the risky decisions of not mitigating the risks adequately. Despite those warnings, apparently it did not work to save the bank, and so there will be many questions asked of what could have been done to prevent this from happening and perhaps reforms in banking regulation in the future.
Absolutely, and we'll be bringing viewers that news conference when it happens in about half an hour, as you say. Heidi, just give us an idea, take us back to the sort of broader picture here, the economic crisis at large, and why the US is facing such high inflation in the first place.
Right. Well, we're seeing here a similar story to all over the world. This is the part of the pandemic recovery with the difficulty in getting products to the U.S., the shortage in labor, all of that leading to soaring prices. We saw record 40-year high inflation in the U.S. In the middle of last year, leading up to last fall. But we did see movement downward in the inflation numbers as a result of the Federal Reserve's aggressive efforts to raise the interest rate. This is the 9th consecutive time that this board has taken this action in just the last year. However, inflation remains stubborn. It's at some 6% at this point, which is already much lower than its peak. However, the target rate that the Federal Reserve wants is 2% for a healthy economy, and we're still obviously triple that. So not only will we be hearing more about the board's decision-making process leading to this 0.25 basis points rate hike that they announced today, but we'll also be getting more of a forecast, what the chair, Jerome Powell, foresees for GDP growth, for how long this inflation will stick around in the U.S., all of those answers to come when he gives his press conference.
Absolutely. For the moment, Heidi Jo Castro, thanks very much for keeping us up to date with all the latest lines there from Washington. Let's cross over to Robert Scott. He's a financial analyst and a former senior international economist at the Economic Policy Institute. He joins us live from Rockville, Maryland. Good to have you with us. So is this the right decision by the Federal Reserve to raise interest rates by 0.25%?
Absolutely. My fear is that it's going to push us further in the direction of recession, and I think it's going to fall hardest on Black and brown and poor workers who will suffer the most if we go into a downturn.
Why do you think it will push the US more towards recession?
Well, the Federal Reserve has raised interest rates 8 times in the last year alone by a total of more than 4 percentage points. Raising rates again will simply add more fuel to that fire. And we have to understand that the economy is like a gigantic aircraft carrier. If you turn the wheel, it takes a long time for that vessel to turn. But once it does, it's very hard to turn it back. So the Fed has to be aiming at a moving target. And I think they're doing a very, very bad job of steering the ship of the economy.
What do you think they should be doing then?
Frankly, I think the problem is not excessive demand, which is what the Fed says they're worrying about, or labor market tightness. In fact, wage growth is slowing. The real problem in the economy is excessive profit taking by gigantic corporations that have gobbled up huge segments of the economy during the COVID recession and recovery. The problem, in a word, is excessive concentration, and the Fed is the wrong agency to fight that. I think we need the Justice Department, Congress, and the White House to address excessive concentration and soaring corporate profits.
I mean, of course, the Fed is more focused perhaps on the immediate term. It's trying to prevent contagion. It's trying to prevent a run on more banks. Do you think that at least is going to happen?
Well, in fact, interest rate increases will only increase pressure on the banks. Higher interest rates make it more likely that more banks will fail as the value of the long-term bonds in their portfolio continues to decline. And so I think this is going to only add fuel to the fire. It's like pouring water on a gasoline fire. It will just spread it further. I think the Fed should stop raising rates and put the pressure on Congress and the White House and the Justice Department to address excessive profit taking.
Okay.
Increases in profits explain more than half of the increase in inflation over the past 2 years.
But how difficult is it for the Federal Reserve to balance calming inflation with calming the problem in the banks?
Well, I think that the Fed requires excessive judgment. And part of the problem is that, as we know, the former President Trump and Congress deregulated the banks. They took off some of the controls that were put in place following the last Great Recession in 2010. And Elizabeth Warren has written a column in the New York Times pointing this out. It was that mistake which allowed the banks to be deregulated and get away from Fed control. But the Fed retains many controls, and they need to focus on regulating the banks, not raising pressure on labor markets, which is what they're doing with further interest rate increases.
OK, Robert Scott, great to speak to you. Thanks very much for joining us to explain a little bit more on this breaking news that the Federal Reserve in the US has just raised interest rates by 0.25%.